Welcome to the third part of the consolidation, where we were working out this question. So we're just doing the workings in the previous two videos. Now we are going to actually consolidate. Okay. Consolidated statement of financial position as at 31st. All right. So we go to our financial statement. Okay, so most of these things will just be adding this and that. Okay, and where we are supposed to add a working, we are going to indicate. So we have our assets. Okay, then we have our non-current, right? Which is PPP, and we will add this and this for PPP, so that will give us 10,655. Okay, so after PPP, here on the question we have investment in beta, so we don't add that one. We replace it by the goodwill. So goodwill was our working through, right? So we say goodwill and in brackets working 3. Okay, so what was our goodwill? Remember, our goodwill was 435. Remember, let's not forget to actually put our zeros there. Very important. Okay, after goodwill, so basically those are our non-current. So our current assets now, we are going to have inventory. And in inventory, we're just going to add also inventory. Remember, inventory is here. We're just going to add these two figures there, right? And we have 3,408. What have I done? Okay, let's erase that. And we start again. Inventory. Okay, we said inventory was 3,408, right? Okay, we have our receivables. Okay, so receivables, we are going to add these, but remember in our note here we were told that 23,000 was a intra-group transaction. Remember, worth of goods. These worth of goods were an intra-transaction, meaning from one pocket to the other. So they didn't actually leave the company. So since company A and company B, alpha and beta, are one company, so it's like you are getting from one branch to the other. Do you have any difference in terms of, do you have an addition or a reduction in the total amount? No, because it's still the same company. It's just that it's like you've gotten from one branch. If it was a person, you're getting from one pocket to the other, but still on you. So that one doesn't change. So, but we had, remember they're saying it had been recognized in the appropriate receivable and payables. So we have to remove it because it was recognized. Or it was included. So when we less, so we are going to add, in this case we are going to add, where are we? So our inventory, we're going to add this and, receivables, we're going to add this and this, then minus 23, right? Okay, so on the inventory we will have 2,746, right? Okay, then cash, nothing changes on our cash, so we're just going to add those two, 25 and 16, so we'll have 41. Okay, so we can add the totals of this. The totals are 27,285. All right. So that is our asset on the asset side. Let's go on the equity and liability side. Okay, where is our equity? Okay, so we have equity and liability, right? Liabilities. Okay, so starting with equity. So under equity we have share capital, right? Share capital, which is how much? So in under share capital, again, one thing to note, we are only getting the share capital for the company, for the parent company, and not for the subsidiary. So we are only going to consider this one. We don't add this one. Please note that always on the share capital we only get for the parent, so that would be 5,500. Okay, then general reserves. Remember we had the calculation or a working on general reserves, right? What was our working on general reserves? What did we find on general reserves? Okay, general reserves we had 1,490. If we want, we can just go back to our share general reserves, right? Calculation for general reserves, and that was our general reserve value. Okay, right? Then retained earnings. What is the value of our retained earnings? Retained earnings, that was 5,557.5, right? Okay, so we're going to add those. Okay, very important. So let's add 5,500 plus 1,900 plus 557.5. So we are going to get a 7,547.5. Okay, so we are done on the equity side, but then we should add the value of non-controlling interest to calculate the total equity of, all right. So what was the value of non-controlling interest? I'm sure we had calculated it also. Non-controlling interest, it was 522.5. All right, let's add that together. We are getting 8,000 and what? That's 8,000. Let's calculate. What's that? 8,070. All right. Okay, let's proceed. 8,070. So that was our equity side. Our liability side. Liability. Non-current liability. Okay, so liability, I think let's go on this page. So we are being given that we have these borrowings, one at 4,000, one at 500. So we're just going to add these two. That would be 4,500. 4,500. Okay. Then so we go to again. This was supposed to come on borrowings, right? So let me just erase that and put it under borrowings. Okay, so that was a non-current liability. Then we have current liability now. Current liabilities. So we have bank overdraft. Bank overdraft. Okay, we also just add the two. Okay, bank overdraft, we're going to have 2016. Then we have our payables. Remember, on the payable side, what we did to our reserves, even for the payables, trade payables, remember, under receivables, the parent recognized, some money that is supposed to come for those goods. For the subsidiary, also it recognized the payable. They're supposed to pay something. Meanwhile, it was in the same group so under the group, we are supposed to subtract that because it's like from one pocket to the other, as we said. So on the payables also, we are supposed to subtract. So we add these trade payables, that and that, then we less 23,000, and that will give us 1,941, right? So we proceed. We have our last entry there as tax. Last entry there as tax. So we just add those two also. It gives us 758. All right. I think we are done here. So now we are supposed to calculate the total from the liability. Okay, so since we had calculated this, so 8,070 plus 4,500 plus 2,016 plus 1,941 plus that, it gives us 17,285. Now, have you realized that this amount is equal to that amount? So the asset side and the liability side are balancing. Okay, so what are we saying? Most of the time, the financial statements themselves, maybe they would attract maybe 10 marks, but where the actual meat of this whole thing is on the workings: group structure, goodwill, non-controlling interests, and if you have any intragroup transaction, any evaluation adjustments, all these things, the workings. That's where the marks are. So please, you can mess up with the balancing of this whole thing, but do not be reluctant on the workings. Workings are very, very, very important. You can pass even like 80% of your exam, even though you haven't balanced any question. So please, note that the workings are very important, and you need to master the art of workings. Okay? Let the statement be just an extra mark. Alright, so this was a lecture from Mathiad Institute. We were just answering one exam question that was suggested by a student. Alright, so if you want more details or more help when it comes to any topic in financial reporting, please don't feel lazy. Reach us out. We have our website, or even in the comment section, you can just drop a text and we shall inbox you as up. All right, now thank you very much, and have a blessed day, colleagues.